my Master's Advanced Accounting class. In this video, we are going to go over an acquisition of a company where the other company is no longer going to exist. So these journal entries that you will do for this particular problem will be different than when it's a consolidation. A business combination where the other company is no longer existing, that company is done. It's going away. So you will make the journal entry for the entire amount. All right, let me go through on how you determine that. So a lot of times when I teach in a traditional class, advanced accounting, students will say to me, Professor Clay, how do I know it's a consolidation as opposed to a business combination where the other company is going away? It will tell you that in the problem. So here's where it says that. So Zambrano Company paid cash to acquire all the assets and liabilities of Soriano Company, which will cease to exist. Boom, right there. That's how you know that that company is no longer going to exist as a separate entity. To facilitate the merger, Zambrano also paid $100,000 to an investment banking firm. Okay, so in business combinations, there's other expenses associated with that. They hired a firm to come up with to help them with this business combination. That will be an expense. With some of the practice problems, if you see that the company issued common stock to purchase the other company, and oftentimes they will, oftentimes they'll pay part cash and part in stock. Whenever they issue common stock and you see anything related to issuing that common stock, that will be debited to paid in capital. So please pay close attention to that. Go back to my PowerPoints on that and take good notes on when you affect paid in capital. All right, so let's look back at the problem. All right, so here's also why I selected this problem. They have alternative accounts in this. All right, here's one of them. Zambrano further agreed to pay an extra $70,000 to the former owners of Soriano Company only if they meet certain revenue goals during the next 2 years. Okay, that will be an example of a contingent performance liability. All right, contingent performance liability is a liability. And that comes about when the two parties have not totally agreed on the purchase price. One party is feeling that they're not getting enough, so they come up with a deal. And that deal depends upon a future event. So that's going to be a contingent, in this case, performance liability. When you have one of those, you have to figure out the present value of that amount. Well, let's go back to the problem. And they did that for us. So it says that they agreed to pay an extra $70,000. However, Zambrano estimated the present value of that same $70,000 is $35,000. So you will only make the journal entry for the $35,000. Be careful of that. So you only want the present value. Please write that in your notes. All right. So now let's look at it. Okay, that will affect the purchase price, not the cash amount, but the consideration transferred. All right, so in the first problem, A, they're saying that the total paid amount is $700,000. However, we have to factor in that contingent performance liability. So let me show you how you do that. We'll go over here, we'll put the cash paid, and that is $700,000. Okay, that's the cash amount. However, I already told you we're going to have a contingent performance liability. And I already told you that we won't make it for 70,000. We will make the adjustment for the present value, which is 35,000. You will total those two together, and that gives you 735,000. So when you figure out the goodwill, use the 735,000, not the 700. Okay? All right, now let's go back to the problem. So here's what it looks like. All right, you working from your book. What we're first going to figure out is the net assets. Remember, net assets are assets minus liabilities. All right, so let's first do that. So we're going to take the receivables, which is 90,000. We're going to take inventory, which is 75,000. We're going to take copyrights. Remember, these are all assets. The copyrights are 480. I want the fair market value. Everybody remembers that. I want the fair market value. Then I'll take patented technology. And that is 700,000. Okay, now, I always stop because if I don't do this, I miss them telling me about something else. All right, so we already accounted for the contingent performance liability. Here's what it also says. Soriano had research and development project in process with an appraised value of 200,000. All right, boom. I read the word in process. I know that R&D I will capitalize. If it didn't tell me it's in process, then no, that would be an expense. This is an asset. Now that's tricky. Here's why else it's tricky. It says, however, the project has not reached technological feasibility and the project's assets have no alternative for future use. That's tricky. They're just telling us that would be that we would amortize that later on. But for this particular problem, we just care that we're going to capitalize this asset. So I read the word in process. I am going to capitalize that. When I do, that's an asset. So I'm going to go over here, R and D, and I'm going to add 200,000. Okay? All right, next. I need to account for my liabilities. So my current liabilities, and that is 160. Show that as a negative for now. And then my long-term liabilities, that is 635,000. Okay? All right. I add these up, subtract, and that will give me my net assets. My net assets are $750,000. Okay, I'm going to erase this in a minute, but that's how we get it. All right, now I'm going to erase, and I'm going to go back up, and I'm going to put in my net assets. 750. Well, look, right here. This is a bargain purchase. I got a great deal. The net assets is 750. I only paid 735,000. That's a gain on, if you had me in undergrad, it's gain on acquisition. This textbook calls it gain on bargain purchase. Bottom line is, that's a credit. That is the same as a revenue account. So gain on bargain purchase, that is $15,000. Okay? All right. So now we're going to go over and we're going to do the journal entry. All right. The 100,000 we will do separate way down at the end. So always do those entries last. All right. So I'm going to go in and I'm going to put this brand new company on the books. And the brand new company that I'm going to add Zoriano's accounts to my company, which is Zambrano. All right? All right. So here's the journal entry. Right over here. Let me draw a line so you're clear. This is receivables. And I have 90,000. That's an asset. I'm going to debit that. Remember, you need to know the basics of accounts. Inventory, also a debit, 75,000. Next, I have copyrights. That's an asset, 480,000 debit. Next, I have patented technology. And that is 700,000. Next, I have research and development. And that is 200,000. Debit. All right. Now I'm going to go to my credits. Current liabilities. And that is 160,000. Next, I will go to my long-term liabilities. That is 635,000. Next, I will do my cash. This one is not an example that they paid stock. They paid cash, 700,000. All right, don't forget, I'm going to make my entry for this 35,000. Contingent performance liability. Jeez. Liability, and that is 35,000. All right, now get in the habit of always totaling your accounts. And when you do, you would catch your debits would not equal your credits. And I do this as well when I do these long problems. I forget to make my entry for the gain, all right? And that's how I catch it. Always total these. Now, you won't have to do that in the lab, but do that for your own notes, okay? Don't forget that. All right, so I would have caught that, which I did, and it's gain on bargain purchase, and that is 15,000. Okay, so that's how you do the journal entry for the A. All right, and then you would make a journal entry. So let me show you over here. Entry for the expense. We've got debit and we've got credit. You would call it professional service expense. And that is 100,000. And they paid cash 100,000. So that's for the expenses associated with the business combination. All right? All right, now I am going to change markers and I'm going to keep some of this problem up to try not to make this video that long. Okay, so here's what it says. Exact same problem, however, now they paid $800,000. Okay? All right, so I will make changes just in red so I don't bore you to death. Everybody's awake out there, right? All right. So we're going to cross this off, 800,000. This stays the same, the 35,000. However, now my purchase price, right, is 835,000. So I paid more. It's not, I'm going to erase this one because it's not a bargain purchase now. I paid more than the net assets. That is goodwill. Remember, goodwill is an intangible asset. Goodwill, I take the difference between those two, 835 minus 750, and that gives me 85,000. Okay? All right. The entry for the expense will still be the same, all right? However, the receivable is the same, inventory is the same, copyrights, patent, research and development, but I'm going to erase, I'm going to erase the gain on purchase, right? And I'm going to add in the goodwill. Now don't forget, the lab will mark you wrong, so list your debits first. So I'm going to go over here and I'm going to input goodwill, and that is the goodwill amount right here, 85,000, which is a debit. I crossed off my I crossed off my gain. The contingent performance liability still stays in there. Remember, get in the habit, total. Total here, and that's how you could catch you made an entry wrong, okay? Sometimes the receivable, maybe you put the wrong amount, or maybe you showed the current liability as a debit. Of course, it will most often be a credit. You might see a weird one where you have a discount on bond. All right, so that's how you do that problem. Get into Connect and get that homework done. And I'll see you soon for other videos.